Welcome to the Stock Market Palantir. Today we are going to talk about WBUY. So WeBuy Global Ltd, ticker WBUY, presents one of the most volatile and frankly terrifying case studies in microcap equity performance out there right now. We're looking beyond just a simple Southeast Asian e-commerce company to examine this profound mix of corporate distress, really aggressive financial engineering, and some truly esoteric market mechanics. The stock is, it's just defined by its structural chaos.
And that is precisely where the real tension lies, isn't it? For anyone looking at this ticker, the fundamental question has to be this: does the explosive, unpredictable price action of WBUY actually reflect its severe financial fragility? We're talking an auditor-issued going concern warning, the imminent risk of compliance failure. Or is it something else? Is the stock price now primarily a function of this engineered market structure, specifically the drastic reverse splits that's turned it into a high beta trading vehicle, almost totally detached from its actual business?
I'm firmly in the camp that WBYU's value, at least in the current environment, is overwhelmingly driven by those structural dynamics and just pure speculative potential. Look, the company's fundamentals are undeniably weak. Nobody is debating that. But the trading activity itself is now a product of financial plumbing, a restricted float, and a narrative just designed to trigger algorithmic buying.
Well, I acknowledge the extreme volatility the reverse splits have created, sure, but I maintain that the pervasive solvency risk, the constant threat of dilution, and that high risk of compliance failure, those are still the dominant forces. They exert a constant, sort of gravitational downward pull that structural volatility only occasionally and very briefly overcomes.
Okay, let me start by really establishing the structural volatility thesis. WBUY's current function in the market is, I believe, fundamentally detached from its initial business model. It now operates as a high-volatility financial instrument created by design or, at least by the necessity of just staying listed. The key piece of evidence here is the massive 2025 aggregate 1-for-120 reverse stock split. This wasn't just some technical adjustment. This moved drastically, and I mean drastically, reduced the tradable float. By taking millions of shares off the market, the remaining shares became acutely susceptible to extreme price swings, up or down, on really small changes in trading volume.
I see why you think that, but let me offer a different perspective. These splits, they weren't some master plan for engineering volatility. They were defensive maneuvers, pure and simple, required to keep the listing above the NASDAQ minimum bid price. They highlight desperation, not genius.
Okay, but even if the motivation was desperation, the effect is still highly engineered volatility. And furthermore, management actively plays into this. They tailor their corporate communications to generate high-impact buzzwords. Consider the press releases focused on the NVIDIA AI Accelerator program or the Victory Securities stablecoin partnership. These are specific signaling mechanisms aimed right at speculative retail algorithms and sentiment scanners. They're designed to instantly generate the volume needed for those short-term spikes. This whole setup, a low float, amplifying manufactured sentiment, positions WBUY as the ultimate high-risk, high-reward lotto ticket for aggressive speculators.
That is a compelling explanation of the mechanism, I'll give you that, but I'm just not convinced that the mechanics can overcome the existential threat. To me, structural volatility is simply the noise surrounding an undeniable and severe financial distress. If we look at the core data, the gravitational pull of its dire fundamentals becomes just obvious. The auditors have raised substantial doubt regarding WeBuy's ability to continue as a going concern. That is not a minor warning. It's the most severe accounting designation you can get outside of an actual bankruptcy filing. It signals that management may not have a credible path to sustain profitability or solvency.
I fully agree that the going concern risk is the single largest red flag for any fundamental analysis. You can't ignore it.
Right. So then let's couple that risk with the liquidity profile. The balance sheet confirms a precarious liquidity position, only about $2.09 million in cash and equivalents against total liabilities that stand at $14.24 million. So a company that owes 7 times more than it holds in cash, while it's aggressively pursuing these cash-consuming pivots into unproven ventures like AI and travel tech. it has a dangerously short runway.
And this cash crunch, as you note, it translates directly into one thing.
Perpetual dilution. This dire liquidity shortage necessitates continuous dilutive financing. We saw the $3.7 million offering in December 2024, and then another $3 million offering in August 2025. This constant need for capital ensures that any positive momentum generated by your buzzwords is immediately undercut by the company selling discounted shares just to survive the quarter. This is the financial definition of a death spiral, a complete death spiral. And what's more, the operational reality, contracting revenue, down 5.48% year over year to $58 million, and deepening net losses of over 11.37 million TTM. It just means sustained fundamental recovery is all but impossible, regardless of the trading frenzy.
That line of reasoning brings us squarely to the core tension in the trading data itself, the high levels of off-exchange trading in short volume. I mean, if the fundamentals are so dire, why do we see microstructure data that suggests an extreme pressure cooker of volatility? Fintel data from November 2025 frequently showed the off-exchange short volume ratio ranging wildly, often between 34% and on some days hitting, 78.65%? If you were strictly focusing on fundamentals, you would interpret that 78% figure as massive short-selling pressure driving the price down.
That would be the natural interpretation. Yes, absolutely.
But I come at it from a different way, rooted in how zero-commission brokerage actually works. That elevated short ratio, paradoxically, can indicate high retail buying pressure. When retail orders for a microcap like WBUY come through these zero-commission platforms, they are almost universally internalized by market makers, often in dark pools. Now, if the market maker doesn't have the WBUY shares in their inventory to fill that immediate retail demand, they use a Reg SHO exemption to sell the shares short to the buyer instantly. This trade is executed off-exchange, and that's what generates that high short sale record on the dark pool tape.
So the mechanism you're describing is more of a necessary function of immediate order fulfillment rather than some kind of predatory short attack.
Exactly. The high short ratio signals market makers are short against overwhelming retail demand. This situation essentially creates a tightly coiled spring of potential volatility. If the price rises, that market maker has to cover those short positions, which just exacerbates the squeeze. For the volatility trader, this structure is the key indicator they're looking for.
That's a sophisticated analysis of order flow, but the fundamental problem remains. The result is almost always the pop and drop pattern. The market maker, who's now short, will inevitably hedge that position by buying shares or just letting the retail interest evaporate. But crucially, the move never sticks. Why? Because there is zero institutional bid to support the new elevated price. Who would step in and allocate millions to a company with a debt-to-equity ratio of over 202%? This financial reality means the price just collapses back down because the fundamental risk profile rejects any sustained upward trajectory. The structural noise creates these transient trading opportunities, but never permanent shareholder value.
Well, let's consider the fails to deliver, or FTDs, as more evidence of this structural liquidity stress. We saw measurable spikes, like the 18,084 shares that failed to deliver on September 12, 2025. Now, in a normal-size float, 18,000 shares might be negligible, but after a 1-for-1 20 reverse split, the entire float is severely restricted. So when FTDs spike in a low-float environment like this, they are classic smoke signals. They indicate the stock is hard to borrow for brief periods, making it highly susceptible to a sudden short squeeze because the supply of shares available to borrow has just temporarily dried up.
Mouth of that reverse split. That aggressive 1-for-1 20 reduction didn't just restrict the float, it created millions of fractional shares in customer accounts, shares that no longer meet the threshold for full ownership. Brokerages are then compelled to liquidate those fractional shares for cash, and that often leads to a sudden, disorganized selling pressure across the entire market.
So are you suggesting that a portion of those FTDs is just administrative cleanup?
Precisely. This administrative liquidation adds another layer of chaos that gets mistakenly attributed solely to malicious shorting. It confirms the structural instability generated by the splits, for sure, but it is downward pressure nonetheless. The structure is chaotic, but that chaos translates primarily into a disorganized sell-off, which just accelerates the stock's descent toward delisting territory.
Let's shift the focus then to the attempt to change the corporate narrative. You highlighted the deepening TTM net losses of $11.37 million. This widening loss, it suggests massive cash consumption on these unproven ventures. The AI travel platform, crypto partnerships. Is this not definitive evidence that the attempt to reclassify the equity from a low-margin food retail company to a high-multiple tech company is failing operationally?
Oh, absolutely. It is failing operationally. They're attempting to command the higher price-to-sales multiples typical of tech companies, which might trade at 5 to 10 times sales, while their core revenue stream remains this low-margin community group buying, which trades closer to 1-time sales. They're incurring tech-level R&D costs without generating anything close to tech-level returns or reliable revenues. The strategic pivot is merely consuming scarce cash, worsening the going concern risk, and thus making the stock a demonstrably worse fundamental investment today than it was a year ago.
Okay, I can see the operational failure. That $11.37 million loss is a massive liability. However, I would argue that the narrative pivot is entirely successful in its intended purpose, which is not solvency, but volatility generation. The purpose is activating speculative retail algorithms. Analyzing WBUY right now is about reacting to those specific keywords: NVIDIA, stablecoin, AI, not reading the balance sheet. And the price spikes confirm that retail sentiment is powerful enough to temporarily overpower the gravity of that going concern risk, offering those massive short-term trading opportunities we've been talking about.
But those opportunities are perpetually fleeting because they are systematically undermined by the company's existential need for capital. We keep coming back to the compliance churn risk and the consequences of the repeated reverse splits. The stock is currently trading perilously close to the $1 minimum bid price, fluctuating between, $1.30 and $2 in late 2025. The entire saga requiring that two-stage process to achieve a devastating 1-for-120 split just highlights the perpetual threat of delisting. This pattern, dilute, drop, split, stabilize, repeat, is the definition of a death spiral, where the company is forced to destroy shareholder value over and over just to maintain the functional status of a listed entity.
I have to acknowledge that this compliance churn renders the stock absolutely uninvestable for any long-term capital, passive funds, or conservative portfolio managers. It's an immediate exclusion for them. However, for the volatility trader, the proximity to $1 simply defines the highly constrained risk-reward boundary. The extreme low float caused by the split means the upside potential on any positive catalyst, even if it's manufactured by a press release, is still enormous. A minor move in a normal stock is an exponential spike in WBUY. For the aggressive, speculative lotto player, this existential risk is actually a feature, not a bug, because it compresses the spring further and raises the beta.
But that low float cuts both ways with devastating speed. It means that when institutional sellers or the participants in the latest private placement decide to exit, or when the next dilution offering hits the market, the price craters immediately. There's so little underlying liquidity or institutional support to absorb the shares that the stock falls like a stone. The structural engineering accelerates the downside risk just as effectively as it fuels the transient speculative upside. In the long run, the volatility is merely accelerating the erosion of shareholder capital.
And that is why WBUY remains such a compelling, if deeply hazardous, case study. It really forces us to define what we mean by value. Is it the underlying cash flow, or is it the functional price dynamics
that investors absolutely must make? The functional price dynamics offer these fleeting opportunities, sure, but the lack of fundamental solvency guarantees that any gains are temporary.
So, to wrap up, we've really illuminated the central tension in WBUY, the deep conflict between its profound fundamental fragility, which is defined by its severely limited cash, high debt load, and deepening operational losses, and the extreme volatility caused by its engineered market structure, specifically that 1-for-120 reverse split and the resulting ultra-low float.
Found nearly guaranteed solvency risk against the potential for aggressive, speculative short-term opportunity. Ultimately, it's a clear case where the functional trading vehicle has become almost entirely divorced from the underlying business reality. But the severe consequences of that business failure are constantly lurking right beneath the surface, driving the longer-term trend.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.